Welcome everyone. If you'd like to follow along with the code, we've got the code I'm going to be using throughout in this repo. You've got every version for every video right here. Today we're going to pick up from version 24. Okay, so if you were to that GitHub repo, you'll find this code in question. I wanted to have a very quick recap before we continue. What we're trying to do at the end of this is to have an extremely realistic view of excess returns and risk-free rates. But in order to do this, we have so many steps to go beforehand that the steps leading to it are actually kind of more interesting. And so first of all, what we're going to be doing here is looking at debts given by governments. We call them sovereign bonds. A bond is a debt. There is some lingo that is a bit annoying. So if I scroll down here, you'll see, for example, so I'm going to focus on the US Treasury. So that's the US government debts. You don't have to. You can go with Euro bonds, you can go with Japanese ones. You see there's UK ones are specific. I think they're called gilts and things as such. But the US Treasury has, first of all, there's a lot of data on it. They're also normally regarded as the reserve currency. And also there is a little tweak that I want to tell you about. Treasury bonds in the lingo is specifically bonds that last from 10 years to 30 years. So they are, imagine it's like a mortgage that lasts that long, apart from you are the actual, it's as if you are the bank giving the US the money, and the maturity is 10 to 30 years. I'm going to be specifically referring to them as T-bonds. If I just say bond, I mean debt. I don't necessarily mean this. So if I say treasury bond, I don't necessarily mean a T-bond. That's because the lingo is quite a bit confusing, and I just speak about bonds in general. Okay, with that out of the way, what we're going to do is we're going to put ourselves in the shoes of an economic agent that wants to invest either in a risky asset or in a riskless asset. But there is no such thing as a riskless asset. And in the world of finance, what you try to do to get as riskless as possible is you buy sovereign bonds, you buy debts from governments. And here, for example, we're going to be focusing on the US Treasury bonds, as I said before. And in order to figure out what the fair value for this kind of debt, this kind of bond is, you compute what's called the net present value. The net present value depends on several factors, such as your compounding factor. So, for example, if you're to reinvest the money that you have every month, you'd have a very quick exponential growth in your investment. Whereas if you only reinvest every year, it's going to be quite slow. The tendency, what is it called? What it usually is 6 months. So it's semi-annual compounding. The convention, that's what I was looking for, the convention. And that's what I'm going to be using just going forward. But today we're actually going to be looking into making sure that you can use any at all. So that's going to be quite interesting. And this is the equation in question. So actually, I'm just realizing that maybe I should zoom in. Let's see if maybe that's zooming in too much. Let's go for view, presentation mode, and let's zoom out a bit. I think that'd be better. I think when I'll be talking about the math, I'll zoom in. Otherwise, I'll zoom out because I can't really see that much with this. And we can see that this is the equation for it. Now, I've been thinking about this equation in question and realizing that maybe there's no need for two of them because the bottom one, whilst it's true, it's completely correct. And I made it to be computationally easier, but it makes things a bit complex in terms of the logic. So I might remove it. We'll see what we're going to do today. And you can see that this is the equation in question. So if your maturity is larger than your compounding frequency, you use this equation where you have your coupons, because bonds pay coupons, again, normally on a semi-annual basis. That's why your compounding interest is usually on a semi-annual basis, by the way. And you want to account for inflation. And inflation is this what we call this yield to maturity. It's also often called either the interest rate or the discount factor rate. I'm going to be using very specific lingo here. The yield to maturity is specifically the discount rate that is going to be assigned to your specific bond in order to give it the price that you see at any one day. So this is the equation in question, including the coupons, so the payments that the bond gives you every 6 months. What this means is that the bond gives you money every 6 months, and you are expected to reinvest it in order to get to benefit from compounding investment. And you add them all up with regards to inflation with this yield to maturity in this equation. And the face value is the last amount of money you're given from the bond, and that's normally either $1,000 or $100. I think if it's on the primary market, so if it's The government's literally giving it to you. Normally it's 1,000, but we're not gonna go down that route. We're actually going to be putting ourselves in the shoes of just a lambda investor who doesn't have access to the primary markets, only the secondary, where normally I think it's $100. Whatever it's meant to be, I know that for the specific bonds that we're going to be looking at, it's going to be $100. So we're going to stick with that. So that's the face value that you get at the end of the bond when the bond matures. So if you have like a 30-year bond, it's 30 years later that you get this face value, this $100, and you put it in this equation to get what's called the net present value. The trouble is we are not given the yield to maturities. We're never given them. Instead, we are given a price. Someone is ready to sell you a specific bond for a price, and you can calculate from that price the yield to maturity in question. And that's how we're going to be jumping forward. Calculating this yield to maturity is going to be very similar to calculating a risk-free rate. And from this risk-free rate, you can then anticipate whether you should invest in a risky asset or in a riskless asset. All right, this was our introduction. If you want to know more, there's plenty more on our developer portal. Let me quickly show you. If I go on developers.refinitiv.com, and if I go on use cases at the top right, then there's a use case called academic. And in there, you'll find this one, Computing Risk-Free Rates and Excess Returns Part 1 from Sovereign Zero Coupon Bonds. Zero coupon bonds, as it sounds, do not pay coupons. And today, instead, we're going to be looking at coupon paying ones. And in the zero coupon bond, by the way, you can go on the right here. It will say source code, and you can go in there, and it will send you to the GitHub repository for that code for zero coupon bonds. We're going to be using some of the code from there. I've already spoken about it in previous videos, and we're going to be moving onwards from there. All right. Last time we used Datastream to get the data that we wanted from Refinitiv. And that's what we're going to continue doing. And once we got the prices, so as I said, we had a price, and then we tried to calculate the yield to maturity backwards from the price. And that's what we try to do here. But in order to calculate that yield to maturity, we had to have some information. So if I scroll back up, actually, I'll take a screenshot because I think I'll go back to that equation quite a lot. I do like to actually talk through these things because sometimes I realize something as I talk about it. Maybe I've made a mistake, and I don't realize it until I talk about it in this way. So this is going to be our equations. If I scroll down, let's have the equation again. Okay, cool. Here you see that you need the face value, and the face value is the redemption value. Oh, there we go, redemption value. That's 100. We need the coupon rate. So it happens to be that unfortunately coupons are not given in like absolute values. They're not given, for example, it doesn't say coupon of $10. Unfortunately, it gives you a coupon in percentage of the face value of the bond. The reason for this is to make it comparable throughout bonds. If it's euros, if it's dollars, if it's things like this, you don't want to change these things all the time. So that's what we're doing here. So we've got our coupon, and our coupon rate is right here, 0.25. I think that's 0.25%. Actually, obviously it is. It's not going to be 25% of the face value of the bond every 6 months. Otherwise, that price, wherever the price is, that price here of pretty much $100 is way too low. It should be high otherwise. And we need all of that kind of information in order to input it into this equation right here, and try and figure out what the net present value should be. And then what we do is we don't have the net present value, we have the price. So what we do is that we input that price here, so approximately $100, as the net present value right there. And from there, we can compute the yield to maturities that are both here and here. And all of these other letters in there we've already spoken about. So the maturity, for example, M is going to be here. So that's the term of the bond. Here is a 5-year treasury. So if it's 5 years, it's called a treasury note. Compounding frequency here is 6 months. We're just going to do it semi-annually. So that's what this ACF stands for, accounting compounding frequency. Accounting? I think so. And that's about it, I think. Yeah, those are all the ones you need. Tau here is just a summation. So you go from tau, and t is just at any time t. All right. So we need all this information. And once you've got this information, all right, let me put that down. We can put it all into the equation I've just spoken about. So you see it gets a bit messy. But I like to do this. I like to go line by line, and I explain, since we are using our price of this much, then we substitute it, we got face value, blah, 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 and then we figure out that our yield to maturity should approximately be, I say approximately because It's not a closed loop equation, unfortunately. It's not a closed equation. You have to iterate through it. And I chose to use, so I made a Python function called yield to maturity solver. And that's what we're going to be talking about today. So I wanted to really talk through everything up to now. In this equation, we're using optimize.newton. Now, I'm not going to change this. And if you yourself, at the end of this, because I'm not going to change it at all, think that there is a better way to do this with another optimizer, by all means, not only you can do it, and you can also submit it to us at Refinitiv through a competition that we have. Again, sorry, I can see that the green screen is not the best, but that's just during the live stream. It's not the best. If you go on use cases and then academic and then scroll down. There we go here. Refinitiv Academic Article Competition. You can enter this competition simply by clicking here. It's going to send you to a form that you can fill in, and you can submit your Jupyter Lab or any other kind of code you've got. If it's not Jupyter Lab, I'll insist on it being text, because otherwise it's just more difficult for virus checks and things as such. But yes, we've already got a winner. He's actually won 3 times. This guy's rather amazing, but he stopped now. So the field is yours to be the winner. So he's won, yeah, the Q3 already, and there's a competition for Q4, which are already open. All right. So if you were to go through this code and find a better way to do it, by all means do submit it, and I'll be very, very happy to read about it. By the way, if I continue looking this way, it's because that's where the screen is, and I mean to make sure that my head isn't in the way of the text or anything like that. So that's why I'm looking on my right, which would be your left, I guess. All right, so we've got our optimization right here. And just not for fun, I was about to say for fun, I've calculated the error, but in order to be able to have some kind of indication of how well we're doing, I've made a little error code right here. The annoying bit about this error is that because we're dealing with such both large values, so 100, $110, and also very, very small values. So yield to maturities tend to be very small. Yield to maturities tend to be 0.0006, 0.00125, and then you want to look into quite a few decimal places as well. I think I'm running Python 32 bits, which is not the best. I should have gone for 64 for this, which means that it would have been a bit more precise. However, precision does not mean accuracy. So to an extent, it's kind of okay. It's doing the job that it needs to do. So much so that I actually did a sanity check at the end, which we're about to talk about. Okay, so this is our yield to maturity Python code, and we've done this solver that uses the face value, the coupon, the maturity, the price at the time, the accounting compounding frequency. Is that what it's called? Yes, annual compounding frequency, because of course everything is annualized, which is a bit annoying for the coupon, because if the coupon is annualized as well, or the coupon rate is annualized as well, but if it gives you a coupon twice a year, then you're going to need to divide it by 2, because inter-year interpolation is done on a straight line arithmetic basis, as opposed to this compounding geometric one that we've been talking about. Don't worry if you don't understand all of this. I'm just saying in case you're interested, and in case that's important for you. And this is the error that I was talking about. Okay, so scrolling on, we in previous videos applied this this Python function, and we checked it. I was happy with the results, but I also noticed I was still doing quite a lot of manual work. So I decided to do this fixed data collection, which collects all of these. What is the coupon rate? What is the yield to maturity? Sorry, what is the term? The term is also the years to maturity. What is the data stream code for the instrument? Those are things that I'll have to ask from Datastream all the time. And so I just made a quick function for it, which again, you can find freely on GitHub and copy and paste at your own will and wishes. And I've put a doc string that's quite long, just because I'm trying to do everything kind of in the same way, and in a way that everyone can understand what's going on. So there's quite little code for the amount of doc string. And I've done again the same thing for price. So we collected fixed information, which is to say the coupon rate that doesn't change with time. We've the redemption value, which is to say normally $100, that does not change with time, until it matures. But even if it matures, that was still the amount that it paid at the end. but also the price, and the price does change with time every day. So specifically in Datastream, we're looking at daily data. Every day we get a different piece of data from there. And I've just put everything together into this one equation function, Python function, because I didn't want to have to write it every single time. It does mean that I've written an enormous amount in doc strings, and these are the doc strings, by the way, the red things, because they don't actually run when you run the function. This doesn't actually do anything, but it's only there for, and if anyone's got questions or trying to understand how it works, I've put an example in there and things as such. All right. I actually don't think I've run this, so let's run this. Kernel, restart kernel and run all cells. Beautiful. So that's what we've done, and then what did we do? Yes, then I had a look at, so this is a very, very powerful tool that unfortunately doesn't work fully at the moment. It works, but not only just to an extent. And what it does is that it searches on Datastream for you. So Datastream is this, I'll go Datastream now actually, is this database from which I keep, you need a username and a password, and not only that, but there you go. I can ask for some specific instruments. So if I was to post this, you see we've got our US Treasury note. This is a specific instrument. This is the specific code for that instrument on Datastream. Can I really wish my green screen was a little bit better, but I don't know how to. There isn't enough light for it. And this is what we've got for Datastream. So our US Treasury note here has the specific coupon and matures in that date. And this is exactly the kind of information that, this is exactly the kind of instrument that this little search, so this search term here, is quite long, isn't it? It kind of starts here, and there's a whole lot of logic that iterates from 2022, on the first month of 2022, all the way to 2027, 13th month, but it's exclusive with respect to its upper limit, this specific range Python function. So it says 13, but actually only goes to 12, which is to say, obviously December. And it iterates through all these years to try and find specific bonds that will mature on those days. And from there, once we have all of these things, what we can do is, if I scroll down fast enough, there should be a, oh, there you go. I was wondering what's going on. Where's my code? It has not run for some reason. I probably didn't define this one. $2027.30. Yeah, it starts at 31. That's why. So yes, I ran this in the past, obviously, previously, and the start date has not been defined. So I think we just have to do start, and let's just do a day before. And yes, by the way, you can actually buy them before they are issued, technically, because I think they're actually issued before the issue date, annoyingly. There you go, 30th, there you go, that works fine. And now we can run from here. Run selected cell, and open up. Take your time. Yes, there you go, got fixed income, fixed information. It is fixed income, but fixed information that does not change with time for each of our instruments. And then, as I said, I did a search, but I already know exactly what I want the search to come out with. So just in case the search changes with time, because there's new bonds being issued, I made a specific list right here, but I left it here just for anyone to copy and paste and have a look at the logic if they want to do something similar. And then finally, I did a little plot. Now this plot is quite interesting. I've spoken about it in the past. Please do have a look at the previous videos for it, but there isn't much interesting for us today in that graph. Then I go back to the net present value. Actually, I'm going to take a new screenshot because I've scribbled all over that one. And this one specifically looks at spot rates, which is more interesting anyway. So spot rates assume that we are actually converting these coupon-paying bonds to zero coupon bonds. And zero coupon bonds, as the name says, don't pay coupons. And that is much more useful to investors because that means that, actually, this graph is going to be useful in the end. You can see that there's vertical lines, and I've added them to show you that in between those lines, there's the same coupons, but outside those lines, it's different coupons. So here we have a coupon rate that is different to here, and is different to there. And so the yields are not really comparable. I think there are to an extent. It depends what you do with them. But to an extent that they're not. You'd prefer to have what's called bootstrapped spot rates. And spot rates are the yield to maturities similar to those if the bond did not pay a coupon. And that's actually quite hard to compute because this scenario analysis is quite theoretical, but it works quite well. But there's quite a bit of work that's needed from it. And this is the equation for it, and you'll recognize it's exactly the same equation as before, apart from I've replaced the yield to maturities with SR for spot rate. Scroll down, scroll down, scroll down. You can see that what we can do is rearrange the equation until we got our spot rates on the left. Now notice that it's capital T, so it's only just the last spot rate we can compute, which means that you need data, and full data really, all up until the time capital T. What's interesting with this though is if you have only coupon bond data, let's say you only have data about coupon paying bonds, well, you can still use this, because what I would do in that case is I would use a cumulative frequency that is lower than the coupon paying frequency, lower or equal to, and most of the time you'd use the one equal to, so 6 months, let's say it's 6 months. Because if it is 6 months, the day the second to last coupon is paid, so let's say I need a realistic 3-year US Treasury. Let's say that the 3-year US Treasury pays its second to last coupon on July 31st, 2020. Well, what I'm going to do is I'm going to go the 1st of August. I'm going to look at the price on the 1st of August, because one day isn't much difference anyway. And because then there's no more coupons being paid apart from the very, very last one when the coupon matures, which is in it'd be December, 31st of December, 2020. The reason and then I'd look at the yield to maturity for this, which you can compute just with the previous equation I showed at the top, with the Python function that we've already created as well. The reason I do this is because even though there's a coupon being paid at the end, the point is that there is no coupon being paid intermittently. So all you have to do is change the face value. You change the face value to the face value that's normally is, which is $100 usually, and in this case you'll add the coupon, and it works. It works perfectly fine. So even if you have only coupon paying bonds, you can use this equation. Beautiful. And I've made this spot rate. So I say last specifically because it's the last one you can get function. And we looked at that. That's all interesting. That's all good. And yes, we saw that there was not enough newly issued bond. A bond, when it's newly issued, is called on the run. And here we can see there isn't enough data. Oh god, the screen is horrible. There isn't enough data to really figure out a curve, a yield curve. The reason you want a yield curve is to be able to compare different yields, different bonds throughout. Maybe test something about the green screen. That might be better. Yeah, that's a little bit better. I had a lamp in front of me, which I thought would make things better. Let's try just that as well. You don't need to see that much of me, I guess. There you go. A bit less of disruption. So we'd like to have some more data here, because otherwise we only have data on 22nd, 2022, and then 2025. There's quite a big gap. So you can use bonds that were issued quite a while back and that will mature later. And in doing so, scroll, we had this whole data frame. So you can see we got a lot more data. But interestingly enough, here we pick up the price at this theoretical date when our investor is making their choices, and we are calculating the yield to maturity specifically on that day, and then we're going to use that yield to maturity going forward to compute our spot rates. And every time we go step by step, and each step we consider it to be the last spot rate, and that's what we did using our years left to maturity. So notice we got a term here, which is normally the years to maturity. But that's not the same necessarily as the years left to maturity, because the bond might have had a life going forward up until the time you picked it up off the run. All right. And then we have a lot more data. This specific instrument, this specific set of bonds are very interesting because I've picked them up in the middle of COVID uncertainty. So you have a lot of zigzags, which is very interesting. But this, by the way, is just a set of checks that I've made to have a look at the yield to maturities, the yield to maturity function, and the error that came out of it, as well as the check. So I made my own check to make sure that we have the same error throughout. And it turns out we do. I'm not going to put this in the article, but I'm going to leave it in the code on GitHub. So if you're interested in this, you can go in there and see it. And then we continue with our spot rates. This time, I think for another instrument. The reason I wanted another, this is the same instrument, but instead of yield to maturities, we're computing our spot rates. There we go. And so that's what we've got here. And here in orange, we've got yield to maturities, and in blue, we've got our spot rates. And as expected, I would expect anyway, the spot rates to kind of diverge a bit, and then maybe to converge a bit. The reason they would diverge is because as you go forward in the years left to maturity, is because there are more years left to the maturity, therefore there are more coupons left to be sold, and therefore the change in price between zero coupon and an actual coupon will increase. This change will increase, and therefore the yield will increase. The price and the yields are related. So this gap will start to increase, but then there's a point whereby maybe someone can see an arbitrage at a specific spread between the two. Now, it's not correct to compare these two as a spread, but you can go with over-the-counter other instruments such as swaps and things as such, and it's much more complicated. We'll get to this. It's going to be our next article, but for now, this is what we've got. And so yeah, it increases in spread and then decreases a bit towards the end. But this is a very specific and kind of odd instrument, so I wanted to get just a normal one. And again, I didn't want to rewrite all of the code, so I put it into a function. And you see it's quite long, but it just does everything that we've already done and puts it into one function. And I'd advise anyone to use this. I'd advise anyone to use that, because this here does not request data from Datastream. And I've done this on purpose because maybe you have your own data, and all you'll have to do if you want to use this function is you'd have to manipulate it so that it looks the same as Datastream data and put it in there. But obviously it'd be 1,000 times easier just using Datastream. And by the way, I intend to rewrite this article using Refinitiv data platform in Icon, because the format's a little bit different, and also there's a function layer within Refinitiv data platform, commonly known as RDP. And the function layer is called IPA. I think it's Instrument Pricing Analytics. Very interesting, very powerful. And you'll see that it's also an awful lot shorter. And that's why I'm going to do this afterwards. First of all, I'm explaining everything from the ground up because this database is not very powerful. You have to do the math yourself. And that's where the interesting academic, and also maybe for those of you that have your own idea of what to do with your spot rates. You can read all of this and tweak it yourself. But then again, once we pass through the theory and the understanding, we can get through to RDP and some pre-made functions. All right, and here this does not care whether or not you have the Datastream. It just picks it up from Datastream anyway. So you need to have authentication and license for that. All right. I've used my functions that I've defined, and I've got all of my maturities. I was extremely happy. This is a much more normal looking yield curve, and I was very happy with this. But then, if you remember, so it's always a half hour. It's always about a half hour of recap every time. Okay. If you remember, we were looking at our bond calculator, and I want to go back on our bond calculator for a short while, if I can actually find out the RIC. Actually, I did a bit of math on the calculator, and I wanted to share that with you because it's very interesting. So today I'd like to go a bit through the convention used for bond prices. So if I was to go for, what was I looking at? I was looking at this specific bond. This specific bond has this specific RIC, and this specific RIC can be found on there. Bond calculator. Now, if you remember, I went through this and I tried to figure things out as I was speaking to you, and it was quite a train wreck, really. Even though this application is absolutely amazing, give it a train out of train. But I kind of misunderstood the way in which these prices are told specifically. So here, for example, you can see it says 102-051, and it gives you the specific price on August 3rd, and the settlement date is actually when your broker was to make the deal. My understanding is that I don't know if it should change in price. I don't think it will. 102.51. So here I've changed the settlement date. Let's change it a bit more dramatically. 102.51. I'll explain what that means by the 102.51. You notice the yield changes, and I think that makes sense. So here we have the price specifically on the trade date. So let's say August 3rd, and this is what it gives you. Now this makes little sense, right? This is not 102.051. That's not what it means. It happens to be that in the past, treasuries were traded in specific fractions, and so people used to speak about treasury notes and bonds in terms of those fractions. So they'd say, okay, it's $100 and 1/32nd, and that's your fraction, a 30-second fraction, or two 30-second fractions. And it went on like this. And it went on even worse. Then it gets 1/8 of a 30-second fraction, and also 1/32. Yeah, that's it actually. And also it happens to be, but I think this is more recent. You can have 4/800ths. So that's not a half. That's 1/200th of a price. And these are the fractions that used to be used ages ago, and it's stuck with the lingo. And so if you hear some bond traders talk about things like this, if they say the price is 102.036, what they might mean is actually 102. 03 would be 3 30-seconds. 6 would be 6/1/8 of a 30-second. And sometimes at the end, there's even a little plus. So if I scroll down, so these, by the way, if you're interested, these I've gotten by hand from the bond calculator on Refinitiv Workspace. By the way, this is Refinitiv Workspace, and I've gotten out my bond calculator. And here, I'm looking for one with a plus. If I can, there we go. Here. So this is the same bond, but on a different date. And you can see, for example, I've got a bid here, and it says 102.03 plus. So 03 will be 3 30-second, but the plus means that I have 1/200th, which is mental, which is 0.005. Now, I much prefer 0.005. I prefer someone tells me, okay, that's actually, how much is that? That's 5%. Why don't you just say bloody 5%? Or maybe 5 per 10,000s, which I would prefer. But no, they prefer to do it this way. Okay, fine by them. And then here I've made a little Excel sheet that converts it for you. I'm still wondering whether I should put it on GitHub, just in case there might be a mistake in there. It took me a very long time to make this, and I made a lot of it by hand. So I'm not sure, I'm not 100% confident in every single cell. There's maybe a cell that I forgot to copy and paste. But maybe if I get someone else to look at it internally and they give it the green light, I'll put it on the GitHub repository that you've seen for you to have a go. But you understood what I meant, right? So here, for example, is 102, which is 102 ones. 03, so 3 30-seconds, and then this plus there, which means that we have 1/200th, which is 0.005. And here we've got this. And I compared the values that came from this bond calculator to the yields that we've gotten ourselves throughout our code this far, and they concur. They concur quite well, not completely, most of the time completely, but sometimes there might be a rounding error, and it probably is on our end. Now, if you're using Python 64-bit, I don't know, you might actually have no issues, because 64-bit is an awful lot more precise. But I'm not sure that floating point numbers automatically go towards the bits of the Python version you're using. If you're confused by what I'm talking about, don't worry about it. I think it's accurate enough, or precise enough anyway, for whatever you're trying to do. Especially if you're just trying to get a yield curve. If you're comparing yields, then it's okay. So what we've got here is our, if I go back to our code, if I find our code, we have, yes, we were looking at our bond calculator, but there's something interesting there. You see, it says clean price. Now, ignore the percent. The reason it says percent is because This is just for one bond, and it's actually pretty much impossible to buy one bond. You have to buy maybe 100, maybe 1,000. I think here it says right there, min denom increase means the minimum you can buy is 100, and the minimum you can increment by is 100. So you have to buy 100 of those bonds, and you can only increment up by hundreds. You can buy 100, 200, 300, but you can't buy 99, and you can't buy 199. It has to be in increments of 100. So as a result, it gives it the other price in terms of percentage, because it's a percentage of the number you're buying. I find that silly, but again, I think it's just convention, and if people are very used to it, and they're doing this day in, day out, you don't want to disturb that. So we've got our yield as compared to our price, which is fine. It works fine. But here, interestingly, we have something called a dirty price. And the dirty price is what I want to implement today in our code. This far, we looked at a clean price. Clean price is simply just the price stated, full stop. However, I want to do things very realistically. And on the trading floor, you're never going to be able to buy a bond on the clean price. Maybe you would on quite literally the second. No, because then the exchange would close. If you do the second the bond is paid, right afterwards, I think the price difference between the clean and the dirty would be zero. But yeah, I think it pays at the end of the day anyway, so the exchanges are closed. So what you can do is you can try and take into account the coupon that has not been paid yet. What do I mean by this? Let's make things a bit more concrete. Let's go back to our code because I've actually written this down. When it comes to yields, if one was to buy a bond in the secondary market, so in the real context, and in context where I'm not an enormous fixed income trader that can shed millions of dollars per trade, at a time other than just when a coupon is paid, so I'm not talking about the second or maybe the day after a coupon is paid. If I want to buy a coupon, if I want to buy a bond, sorry, in March, that's going to be rather difficult because I think there's low liquidity in bonds issued in March. So the coupons are going to be sold 6 months later after maybe July, so at the 31st of December, which means I'm going to be right bang in the middle of when the coupons are paid. What does that mean? That means that the bond seller would lose out on the upcoming coupon payment. In other words, if a bond worth $100 face value was to pay, let's say, 10 cents coupon a day, and was sold on the 30th of January, then the bond seller would have gathered $18.6 in coupon payments during that half year. So during that 6 months period, would have gotten $18.6. However, the coupon payments are not made every day; they're made every 6 months. And usually, so for example, with the instruments that we're looking at ourselves on the 31st of January and the 31st of July. So the bond seller would actually not have gathered this $18.60 per bond up to the time when you buy it. And that investor's not going to be happy with this. They're going to be losing out on that entire 3-month waiting time. They were waiting for the coupon to come 6 months later, and they waited 3 months, and now you want to buy the bond. They will not going to allow you to buy the bond for the price of the bond without taking into account the coupon. So to compensate for that loss payment, bond sellers on the secondary market do not tend to sell at the net present value, so at this fair price, this clean price. They instead sell by what's called a dirty price, where we have this coupon payment loss taking into account into the price that they sell it to you, and that's called the dirty price. And what we've done here is that we've actually accrued the coupon payment in the price of the bond. So there's quite a lot of lingo there. I try to repeat myself several times to make sure that it goes through, but I know it's a bit quick. Still, it's a bit much. So do tell me if you want to repeat myself. There's a chat that you can, or comments that you can use. One can see then that since the bond price and yields are related, as we've seen in the past, then as the bond price change, if we're looking at dirty price as opposed to a clean price, then there's also a dirty yield and a clean yield. And that's what we're going to be looking at now. And that's very, very bloody difficult. The reason being let's go there. Here we have a price. Oh, let's see if I can find one that's not, probably not actually. I just want a decimal. Yeah, it's not going to give me a decimal. It gives a decimal here though for the dirty price. What it's saying is that the price of the bond is actually, I should have something there. Scroll down. That's okay, I don't need that. Risk-free rates, conclusion, appendix, there you go. Blah, 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 blah. Here, I did a sanity check. And in this sanity check, I use icon, and in there we'll find the data that I was talking about. So there you go. Here, what we're going to get is the... So we've got several bonds with a specific year to maturity. There you go. And a price from Datastream and a price from icon. And you can see here we have a clean price, clean ask price, and yield to maturity is given. So where's the dirty price? Damn it, I didn't write dirty price in there. By the way, this is in the code, so if you're interested in icon as well, there's everything in there. And this is what I used to make sure that I get the correct yield to maturities. But I wanted to check more than one type, so I did ask, I did bid, I did mid. There you go, to make sure I get the correct things. But this is all clean prices, and the yields are given clean on icon. So that's not a very good example, is it? Let's go back to our bond calculator. Here we have a price. Let's say it's 102, and let's just say it's 102, just to make things. Actually, you know what? I can make it 102, just manually. Let's wait a bit. There you go. So this is 102. However, this is a clean price, $102. But you can see the dirty price is 102.105298. It's not quite 102. The reason for this is that this accrued interest here, the about maybe 11 cents, they come from the number of days left to the next coupon that the seller of the bond did not collect. That's what it is. So the bond seller waited, let's say, 1 day apparently, waited 1 day, and for that 1 day, they're going to charge. That's quite a lot. It can't be 31 days accrued. Let's do this instead. Let's do 102 again. Oh yes, I didn't change the settlement date. Let's change the settlement date. There you go, 53. Oh yeah, of course. Yeah, there you go. So actually, it wasn't that high. So let's say it was $102, and the number of days until the next coupon payment in this case is 53. There's 53 days left to the next coupon payment. So the bond seller has been waiting for several days and did not receive a coupon payment, but they want to. They want to receive the coupon that they deserve for having waited without reinvesting the bond, without selling the bond, without doing anything with the bond. And they incorporate that lost coupon payment, and that is called the accrued coupon, the accrued interest. And it is added, so you see it says 102, we're going to add 18 cents, and there it is, 102.18, and then some dust at the end. So that's what we've got here, and that is what I'd like to implement. However, you may be asking, whoa, how do you go from 53 days to 18 cents? That seems out of the blue, doesn't it? Well, it's actually just a straight line interpolation. So it's really simple to explain, so I might as well just go for paint. Why not? Let's say that we have time. Let's say that, and this is the compound interest. Yeah, I guess interest, compound interest. Let's say that we start at, I don't know, 102, wasn't it? 102. Ah, there you go. As time goes by, the seller of the bond in question, let's say that they collected a coupon specifically on at that spot right there. They collected a coupon. Now the price of the bond, the net present value of the bond, is not going to change until the next coupon day. And let's say the next coupon day is then. At that point, Sorry, no, let's put it there actually. Ignore that one. Ignore that one. So yeah, it goes on like this, and then boom, that's the net present value, by the way, of the bond. And then boom, it hits the coupon paying day, and then boom, the coupon is paid, and now it's worth more. It's worth 100 and I don't know, 3, let's say, just for math's sake. All right, let's say that you are buying the bond at that point right here. So this is the net present value. It's not very easy. And let's say you are buying the bond specifically at that point in time. And you would expect, the clean price and net present value of that bond is 102 at that point. So maybe you'd expect to pay it for 102, but the seller of the bond, in his head or in her head, she's been thinking about it like this. Damn it, it's meant to be a straight line. Can I go back? I can. I want to make it very distinct that it is a straight line because we're doing straight line interpolation. So what you're going to have to pay is actually oh, damn it. I just want a normal brush. Is it not going to let me? There you go. Yeah, there you go. It's going to be this one right here. No, just normal brush. There you go. This one right here is going to be that price. So ugly. There you go. Boom, boom, there. This is going to be the price that she's going to be asking for, which is going to be in between 102 and 103. In our specific example here, the difference between here, let's say this is day 0 after the second to last coupon, let's say, and this is the 52nd day, isn't it? 53rd. Ah, damn it, 53rd. So this is our 53rd day, and is that right? No, that's not right. Go back. The distance between this and that here is 53. That's what it means. And the seller of the bond wants compensation for the days left to coupon payments. And therefore, let's say that the distance between the two here is worth 0.18. Let's say it's just worth 18 cents approximately. You see, it's 18.002717. I mean, I'm making very rough approximations here, but this is the theory. The seller of the bond is not going to be wanting to sell it to you at a clean price. At the bottom here, it's going to try and have this straight line interpolation of the lost coupon payments. In this case, it's 18 cents. Now, if the price is different, which it is, it's not $102, it's $102.18, then the yield is going to be different. You can see here, where is it? Oh, I thought there was a dirty yield somewhere. That's annoying. Does it give you a dirty yield here? I'm sure there's a dirty yield somewhere you can get. Oh, there's so much stuff on there. It really is an amazing tool, but there's too much even for me, specifically for me. I don't trade fixed income. But yes, you can get a dirty yield as a result coming from the dirty price. And that is what I'm going to try and incorporate. However, it gets very, very complicated because of the years left to maturity. All right, I've spoken long enough, and I'm actually quite happy I did because I've solidified things in my mind. I know what we're going to do. And I've also made sure the yield to maturity, the yield to maturity solver works. I've made sure of that with the sanity check that I've shown you at the bottom using icon, as well as Datastream. So now, if you remember, we had this yield to maturity solver, and I've put it in this, in this separate file just in order to be able to see it. This is not actually a file that runs at all. It's just there to have a look at the code itself. So as a result, actually, we don't need any of the doc strings. Let me remove it. I'm never running this, so it doesn't matter. All right, so what this does is that it incorporates this equation. And in this equation, you can see that we have two equations. We've got one at the top, if maturity is higher or equal to frequency, and if it is smaller, and this is what it does right here, you can see that it incorporates the coupon because it might be a coupon paying bond, and that very last date, the maturity date, it still pays a coupon. So let's say the coupon is $3 and it's a face value of 100. At the very last day, it's going to pay 103 as opposed to just 100, like a zero coupon bond would. So that's what we've done here. You see, we've got if m is larger or equal to the annual compounding frequency, then you do this, and else if it is smaller than the frequency question, it's a much simpler equation. The reason I did error equals 0 is because mathematically it has to be 0. This is a closed loop equation. Where is it gone? Where's it gone? There it is. This here and here is a closed loop equation. You can rearrange this equation at the bottom to get your spot rate, and it has to be arithmetically perfect, although maybe not infinitely precise, but definitely accurate. Whereas the top one here, you can see you've got more than one spot rate. There's one here, there's one here, and actually there isn't just one here, it's for every tau, because we're iterating through that. Oh, you can't see, I just noticed I was in the way. We're iterating through that summation, and by doing so, we've got tau. Actually, we've got tau. Tau. Yes, we do. We have tau spot rates. Tau, by the way, is just like T or A or B. It's just a Greek letter instead. I think I just ran out of normal letters. So that's what we've got here, and that's what we've got there. So we've got our logic. This is very simple. And I was actually thinking about removing it because then I wouldn't have to bother about two of them. But no, it's very useful here. My biggest issue here, however, is going to be there. Why? Well, because in order to figure out the maturity, the issue is not in this function. So what this function does is that it takes into account the maturity given, full stop. It doesn't care about the rest. That's actually quite good because it means it's less work for me. Because the user needs to know the maturity needed. I'd like to iterate it though. Okay, so in order to figure out the maturity left on a bond, so if a bond is issued in 2017, the 1st of January 2017, and I buy it on the 1st of January 2020, I know that there's 3 years that's already gone by. So the years to maturities have gone down by 3 years. Let's say I buy a 10-year bond in 2017, and I buy it. Sorry, I don't buy. There is a 2017 10-year US Treasury bond issued in 2017, and let's say that I buy it in 2020, the 1st of January, then the years left to maturity have decreased by 3, so it's actually 7. So 7 years from when I bought it. And I need to take that into account. And it gets worse if you don't buy it on the 1st of January, because then you have this accrued interest that you have to take into account. And from that accrued interest, then what we're going to be doing is getting the dirty yield, the dirty price. From the dirty price, we're going to calculate the dirty yield. So really, we don't care about the dirty yield, we care about the dirty price. We already have a clean price from all of our code this far. But the biggest issue is that if I show you, to figure out this spot rate, to figure out this yield to maturity, we have used this years to maturity. So it's the years left to maturity, which makes sense. And notice that they're always in increments of 0.5. The reason being that we're using a frequency that is semi-annual. But now I need to make sure that, you see I divided it by 2 here, which is not necessarily correct. So it is correct for us because we're doing semi-annual work. But what if someone is not doing semi-annual work? What if someone reinvests every 3 months instead? That is a mess, isn't it? So what if the coupon paying and the compound frequency, the both 2 frequencies, what if they're not the same? What are we going to do then? Let's have a look at our equation. If they're not the same, it shouldn't matter. It should not matter. You can just plug it into the equation anyway. In which case, what matters is this here. The reason is, yes. All right, let's have a look at how we've made this, because the way we've done it is quite peculiar. So this is what I've done here. We've divided it by 2. What that does is that it makes sure that it's in increments of 0.5, as opposed to it could be 0.001 or anything like that, and it wouldn't work here. No, that's not the one I'm looking for. The code I'm looking for. I've actually written it down, but I want to see the function that it comes from. No, it's going to be the yield to maturity calculator. Yeah, it has to be. So it is actually this code. Yeah, it is. This is what I'm looking for. So what this is the coupons. The coupons that are being paid. The coupons that are being paid here obviously they're not going to take into account the last coupon paid. However, my problem is that if let's say that the number of coupons left to be paid, let's say that it's 1.9, right? So that's annoying. It's not 2. There isn't 2 coupons left to be paid. Let's say there's 1.9. So one have just been paid, just like a day ago. How is the code going to take that in? So let's have a look. I think I was doing some testing at the bottom to look this up. This is the code we're using. We've got a frequency. Let's leave it to 0.5 for now. Let's say our coupon is whatever it is. Let's say 0.125. Yield to maturity. Let's say it's this. But what if our maturity, let's say it's 1.25, yeah. Yeah. If it's 1.25 and we're doing semi-annual stuff, then I would expect only 2. Yes, that's what happens. Okay, that's cool. Reason being, right? So what's 1.25 times 2? It's 3, right? Sorry, it's 2.5, and I wouldn't expect the 0.5 to be in there because that coupon doesn't actually exist. The coupon is the one that the 0.5 coupon is the one that's gone by, that's already happened, and the 0.5 left is how much is left to be paid. Now let's say it's not 1.25. Let's put 9, and it's going to be 3.8, right? So yes, I would expect 3 of them. Let's try that just to see that this should work. The math is all correct, right? But I just want to see that if the code actually does it correctly. Now, why would it be? Oh yes, because it's the range function is exclusive with respect to its upper limit. So we want 3 of them, but it's going to show you 4 because it's not going to use the 4th one. It's going to ignore it. So it's going to use 3. Boom, fantastic. How far can I stretch this? Because it needs to be very precise. Yep, it works. In that case, we don't want to see it with, what about 37? I want 15 of them. 1, 2, 3, 4, 5, 6, 7, 10, 15. Fantastic. Yeah, it's really 16. Again, just making very sure that it's doing it correctly. But this is really cool though, because this works. And what our code is going to do is that it's going to ignore this 0.9. 0.99999, it's going to ignore it. And it's going to give you only the amount of coupons left. And that's really good because we know that the 0.99999 is the, yeah, it's the straight line interpolation amount that are left. So what I'm saying here is that there's 99.999% of the coupon about to be paid left to be paid. If it is 7.9999, it means we've just about paid the last coupon, the 8-year coupon was paid just maybe yesterday, like a very short amount of time ago. Therefore, we want little money left to be paid, don't we? Because if we look at our graph, did I close it? I did close it, didn't I? Just make a very quick one. If you look at our graph, we had something like this, and we had our price that was like that, and then we had our straight line interpolation debt, and then we're saying that you want to price there, but no, it's actually going to give you this one right here. There. I need this visual for myself just to see what we're doing. Let's say that this was the 8th. So this is going to be the years. Oh wow, there we go. To maturity. Let's say that's what's left. So it goes down with time. So here there's 8 years left to maturity, and here there's 7 years left to maturity. Let's say this isn't in the middle. It looks in the middle. Let's say it's not. Let's say this is 7 point. I don't know. Yeah, let's make it close. 0.7. 7.7. So this is going to be specifically for this bond. This bond being, I don't know, a bond with these characteristics. All right, so we got only 15 of them. There's 16, so there's only 15 left here, and it gives me 0.4. What the 0.4 should mean is that there is, okay, so does that mean that there is 0.4 of a coupon that should be paid to the seller, or that should be paid to the buyer? By which I mean, is it 0.4 of a coupon bond that should be paid to the seller, or is it 0.6 that should be paid to the seller? That is the bit I'm confused about. And it is quite important. I'm just going to do that. I know you can't see the years to maturity, but you know what it is. Yes, okay. So as we go closer from 8 to 7, the price should increase. So here we have 16.4. So if I go 7.9, I expect this decimal to increase, which it should. No way it wouldn't. Yeah, okay, cool. Yeah. And this decimal is a representation of exactly how much time has gone by since the last coupon payment, which is brilliant because what we can do now is that we can take that decimal, we can take the 0.8, and how are we going to take the 0.8? How do we get decimal? Let's just Google it. How to get decimal from float Python. Does it work with any of them though? Float. Oh, I see. Does it convert it to a string? Oh, I see. It takes .2. I don't know if that's going to work for any of them. So it tells me to do that. So X would be here, for example. Let's say 16.999. I just write anything at all. Let's see what comes out. No, this is not at all what I was looking for. What enough is that? What if I round? Actually, maybe I'm being stupid. What if I just round? Oh, it's going to ask me to what decimal point? 0. Yeah. So maybe I can do that. So what do I want to do? I want the amount left. So 17 minus that. Damn it, yeah, it's going to do this. Oh yeah, no, it should be the other way then. But then it's going to be negative. No, I'm being silly. It's just 1 minus all of that. What is that? Should work. God damn it. Yeah. Why did it take so much work? I don't know if it should take so much work. There should be a simpler way. Yeah, no, this is not good. Yeah, there you go. I was sure there was a way to do this. Let's try it like that. This is the remainder, but the remainder is normally for divisions. Yeah, and you see it rounds up, and it's not the best. What about 0? Yeah, no, it doesn't want to like it. What about 0.1? I don't think it's going to like that either. Oh, I see. Oh, I see. No, it's dividing. Oh, that's clever actually. So it's getting the remainder from the division with 1, which is going to be the decimal. It is off though, isn't it? It's more Pythonic, so I kind of like it. I wonder if I should use it. Let's have a look. What does that say? 985 478 45, and you see here goes 1. It's always a bit off. Oh, so is this one though. Oh yeah. What was the previous one? 5.55. Let's try that. Damn it. So you see, this is how I want codes really. Just Google trial and error. Specifically when we do this anyway. Yeah. There's always an error anyway, which would make sense anyway. That's annoying. So this is better. The remainder by dividing by 1. So if we do this, then it's going to get us this 0.8. And what we want is the 0.8 from the coupon. I need to deconstruct the whole thing. Let me just stop that from pinging. There we go. Let's deconstruct this. Okay, so where is this important? This is important in there. I don't want to do it here. Let's do it. Let's do it the other way around actually. I want this code, and I want this code, and I want to keep in another window. It's not much code. I should be able to remember it, but just in case I don't. And we're going to see the yield to maturity. It's at the top. It's high up. Solver. There you go. So this is our solver, and here it is. This is it. This is the thing in question that. So what this does is that it gives us everything clean, and it works quite well. We want to add on top of this the dirty price. That's the issue though. We need the price, and the price is given here. That's annoying. Okay, so the price is given. It's just given. So the person in question using it can just input the dirty price. And the dirty price would be the remainder of this divided by 1. All right, so that's fine. So next time we use the yield to maturity equation, we can just use the dirty price. Let's try that. Should work, so let's do it. When is the last time we used our yield to maturity solver? We used it here for that. So now let's do the same, but with Ah, yes, and there you go. This is where it gets tricky. I used a specific function called getDSWS spot rates. That function was defined here, and that used another function that I've defined called getDSWS spot rates from df, which is sensible. And this one from df does not. There you go. Coupon paying frequency, number of existing spot rates. I'm thinking of something. Let's see if it's important. Let's see if it's important later. Maybe there's no need to think about it. So this is from DF, and we've got all of our stuff. Gone wonderful. We've got the price as of that date, and what this code does is that it goes on Datastream from whichever point is demanded for whatever instrument asked, and then we get the yield to maturity implied by the thing. There it is. This is interesting. I think here, boom, I said boom. There we go. Between here and, so this is number of years left. You see, that's going to change as well. Yep, that's good. Yes, it is. So boom, boom, get spot rates. Are the spot rates going to differ? Of course they're going to differ. Oh, the spot rate's going to be annoying. How is one going to go about the spot rate? The spot rates are computed for each compounding frequency that we are looking at. However, if we're going inter-compounding frequency, how are we going to compute a spot rate? I don't think you can. I don't think anyone would. What if? I think it doesn't matter. Because you are buying a bond at a dirty price. You're still getting the coupon, but you basically just paid the accrued interest. And then you're getting all the other coupons anyway. So you're still paying that price and you're still getting the coupons. So the spot rate, the yields, everything else should be the same. It is offset. No, it's offset. It's offset by the number of days accrued at the end. So at the end, so if you were to buy your bond, let's say in March, which is like 3 months, let's say 3 months after it's issued, and then you only get your coupon 3 months later as opposed to 6 months later, at the end of the bond's life, the end of the bond's life is still going to be on the 1st of January, and our calculation is still going to expect another coupon payment on the 1st of January, on the 3rd of the year, in March. Our computation is going to expect a coupon payment in March if you buy it in March, even though there might be none, because the coupon will just mature in January of whichever year it matures in. Okay, it's a lot to think about in one go. So instead, let's do everything step by step. Let's get the yield to maturity from a dirty price, because that's very simple. Let's do that here. The simple thing that we have to do is exactly the same as what we've done before. So copy that, paste it here. By the way, if you're interested in what these orange lines are and stuff like this, it's just a little extension I've got that makes sure I stick by a specific convention of coding, so that it's easier to read for people. So get dirty, yield to maturity implied by the point in time date is going to be called the dirty yield to maturity implied by that dirty price. The face value is going to be the same. The coupon payment is going to be the same. The Now I know that we can change the maturity. We can change the maturity to be that decimal that we want it to be. However, yeah, if we change it to a decimal, it will take the coupons. And it will ignore the last one, which is actually the first one. Is that right? Yeah, it is. So the coupon payments that are summed are correct in our yield to maturity solver. That's fine. So we can leave the maturity, whatever it is, as a matter of fact. Yeah, that's fine. And the price, however, that's where it gets interesting. So the price at that point. But on top of that price, I think we're correct in simply just adding the accrued interest to the price, and then the yield is going to come out on the other end. The coupons are going to be added correctly because it's going to ignore the decimals. So let's try that. What have we got? We've got. Let's do it correctly because this is a bit of a mess. All of this, let's call that capital M. Am I using it somewhere else? I am. I'm using it here, and that's it. So let's just, because we're using it several times, let's put it there. I was using it several times to start with, so maybe I should have done this before, but either I was too lazy or if you're only using it twice, maybe it's not enough to make a whole Python object for it. But I'm using it more than twice now, so M here is going to be M there, so that's going to capital M. Now, this is our dirty price. It's going to be capital M. We got our price, and from our price, what are we going to do? Well, first of all, I'd like to add the coupon. So whatever this is, again, I'm using it a lot, so let's do that again. It's the same thing, isn't it? But let's make sure it's the same thing. If I highlight this, it doesn't work. If I search for it, there you go. Yeah, oh, 3 times, bloody hell, yeah. All right, let's do that then. C equals this. Let's remove it from here to here. Nope. There. C, that's going to be C. Oh, it is the same. Yeah, it is the same. Plus, now, we don't only just want C. We want the actual maturity given, which is to say, I think it's this right there. No, so we've rounded this, right? It says round. There you go. So why would I do 2 times? Oh, because I divided by 2 on the other end. It's just a trick. I think this is it. This is it. So that's what I want. Let's just make sure that that's what I want. How can I make sure? Is there a way to leave a mark here? No. Sometimes there is. Okay. I'm just going to copy and paste it there so that I can search for it later. Okay, so boom. And I'm going to test down there with the rest of my tests, wherever I can find them. Yeah. Here it is. So I can test this, but instead of instead of bond df, I can use a data frame that I've created just for this, which is some instrument. I think it's the same as this. I think I already did the test, but I can't remember if it's exactly that. What's the point in time? Does it matter? Let's just use that one. That should work. What's wrong with it? Oh, what's the error? Non-integer key. Maybe that's the error issue. Maybe I selected a time that doesn't exist. Oh yeah, I. What the hell's I? Yeah, what the hell is I? Let's just do 0. This is just the row, by the way. If you're interested in this, I'm selecting the 0th row. I don't think it matters anyway. All I want is this. So it's giving me this 0.5 blah blah blah. However, I'd like to see the rounding. If I can find the bloody thing. There it is. Yeah, I just happen to have it somewhere else. If I do this, now if I do the same thing, yeah, but if instead I do all the whole rounding shinababub, the shinababub. Up. Let's do that. Up. I don't know why there's 2 brackets. Let's point it out. Why is there 2 here? That makes more sense. I don't need 1 there. I completely forgot what it was meant to be to start with. Control Z, Control Y, boom, oh no, not quite. Damn it, I don't know what the hell that is. Control Y. Control Y goes forward, by the way, Control Z goes backwards. There we go, we'll choose the 0th, run this, 0.555. This one 0.5, which makes perfect sense. It's exactly what we want. Beautiful. So I can just use that then. Beautiful, beautiful, beautiful. I think I copied it on a notepad. I've got it right here. So I can go back up to my, there it is. Now I don't want to add C to it. I don't want to add the actual coupon amount. I want to add a specific amount of the coupon in question, and that's the decimal left. In order to do that, I'm going to be doing, so what did I call it? I called it the remainder. Remainder. And it's going to be this. Do I need that many brackets? Oh yeah, I do actually. That's annoying. Boom, boom, boom. Yeah, that's fine. That's my C remainder, but it's not remainder yet, is it? I need to put all that in brackets again. So many brackets. I prefer to have too many brackets than not enough. And then percentage for the remainder by 1. So that's going to be the number of decimals left. And the closer we are to the previous coupon given, the higher that decimal is going to be. Exactly like we. No, we don't want it like that at all. Let me make sure that's. Yeah, that is that way. That's not what we want, is it? So 7.9 gives us 16.8, and that will be 0.8 accrued, according to my theory. So if I go 0.8, so if I go 7.4, yeah, so it goes up and down in tandem. It's the other way around, isn't it? Let's have a look at our graph. 0.7 is giving us 0.4. Let's just write 0.4. Why not? 0.4. And then 0.9 is giving us 0.8. In 0.9, let's say it's here, 0.9. And this, according to Python, it's 0.8, which makes no sense. See, this is lower, not higher. I know that the x-axis is going the wrong way around, unfortunately, because it's the years left to maturity. So as time goes by, we're getting closer and closer to the years of maturity, so it's getting lower. However, actually, maybe there shouldn't be an arrow this way, maybe the arrow should be the other way. However, this is definitely going the correct way up. Up is more. So we're not going from 0.8 to 0.4. That can't be right. Should we do 1 minus? I think we should. Because it's a straight line, we're going from 0 to 1. So yeah, I think it makes perfect sense. So I want the remainder. So if I did want the remainder, I would do. Let's ignore everything else because too much crap in there. Let's remove that. And let's put up, copy this, paste that in. Let's make sure we've got the correct remainder throughout. So I'll put this in brackets. And at the end, let's get the, yeah, that's right, percentage remainder. Should be 0.8. Yeah, close to 0.8. Oh, that's annoying. However, I want to do 1 minus that, don't I? 1 minus that. Yeah. Yep. Yep. I think that makes sense. If I go up, too far up. So I've got everything here. This is all my stuff. And here it is. No. My remainder is here. So this is my remainder, but I want to do 1 minus it. So again, so many brackets. But I don't want it to be confusing. I don't want it to be, sorry, it is confusing, but sorry, it isn't ambiguous. Okay, it needs to be unambiguous. So -1. No, not -1. 1 minus. Yeah. 1 minus. Oh yes, by the way, just by convention, you kind of want everything to be kind of in a column. You don't want it to be, for example, like that. If it gets too far to the, actually this is fine, but not like that, because then it's very simple to end up with something that bleeds over the line, and you can't see it anymore. And many people that will read your code will not have maybe a screen as wide as yours, and might be smaller. So you want it to be. There is a convention that says that it should be so. Way too far down. So much, no more. There you go, that's fine. So this is a remainder. Yeah, that makes sense. And this is the price. Okay, so that's the C remainder. And this, not C remainder, that's just the remainder. And we want to do the coupon price times the remainder. I'm going to do this just because that's not how it's normally done in maths. I don't know if that's how it's normally done in Python, but you put the multiplication things right next to each other, and the addition and the subtractions, put some space. Reason being, you do them first. You do the multiplication and divisions first. And just in case, again, I don't know if Python does them first. Put in brackets. What is this going to do? This is going to give a price. It's going to give that price. I'd like to have the price though, which is not written here, is it? It isn't. So, get the dirty price. Dirty, no, dirty price as of point in time. and it's going to do that. So what this does is it takes the yield to maturity. We don't want the whole yield to maturity. All we want is the price. So the bond, blah, 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 that's correct, yes. But there isn't only just one, because we don't only have one bond in this specific thing. It's a series of bonds in this specific scenario. Should I? Can I do that? No, obviously I can't. Yeah, right. So the dirty price. No. How did I do the price? Price on. There you go. So let's do that. Let's do this. It will be dirty price on. If it just says price, it will be clean price. If it says dirty price, it will be dirty price on that date. Yes. Now that we've done this, though, we need to make it clear to whoever's using this that this is what's being done. So in the doc string, I'm going to say this Python does all of that. The dirty price provided incorporates accrued interests of the next coupon in the cash, no capital, cash flow. I capitalize terms that are very specific to the article that we're looking at. So here it's coupons, it's bonds. Dirty price is quite interesting. So, but cash flow is it's not very unique for this. And this is not going to be version 1.0 then. Oh no, it is because I haven't published it yet. And you can use it, but I consider it actual 1.0 once it's published on our portal. So this is still 1.0. Does that make sense? The dirty price provided incorporates. Did I spell that correctly? Accrued. 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 Yeah. Interests of the next coupon. The dirty yield reflects that dirty price. I'm thinking about the dirty yield again. We've seen that the coupon payments are correct. Yeah. The coupon payments are still the same, but the price is going to be different. So the yield is going to be different. However, is it going to be correct? That's the thing. Yes, I think it is. Is there any need for any new dependencies? No, we didn't use any new libraries, any new Python libraries or anything. Let's explain what we're doing here. Here we are defining objects used many times. Boom. We're not using these above, are we? No. Right. So that's what we're doing here. Then we've got our maturity, then dirty price, then dirty yield to maturity, then the number of years left to maturity. Now that is an annoying one, isn't it? Because it's going to be different for clean and dirty. Number of years left. Should we call it clean and dirty as well? Would it be different? Yeah, it would be different. Yeah, I want to change that. Or not change it, but add it. Copy this. Paste it there. Get to the number of years left. Get the exact slash dirty. I'll spell dirty with a capital D to explain that this is the financial fixed income version of dirty and no other type. No need for Hoover. Here we have our years from that date to maturity, but I'm going to call it the let's call it dirty, I guess. Dirty. Blah, 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 blah. And what it's going to do is not going to round it. So here what we've done is that we multiplied it by 2 and then we've divided it by 2. and we've rounded it obviously. So let's remove the rounding and let's remove that. It's going to be the exact amount. Yeah. I think I need this, do I? I can just do that. I don't think I need that either. Yeah. But when I say I don't need it, I mean I don't need to go to a new line every time. I think I needed to here. No, I didn't need to. Just about. Yeah. Let's save this. So this is 24, sorry. So we're going to save it as the new file. 25. Again, you can ask me questions on the chat. I see there's nothing there yet. I'm going to continue. Normally my streams are an hour and a half, but I'd like to finish this bit because this is the accrued bit and it's quite important and interesting. So now we've got our exact number of years left. This is the spot rate. Now, this is getting important. The spot rates are very specific to the frequency used. So I think, I don't know if it is applicable. I don't know if you can have a specific spot rate, specific like this at that point. What's the difference between the two? What is it that we're doing within the spot rate? We're using our equation, as we can see here. Let's have a look at the equation. We're computing this spot rate exactly like we did with the yield to maturity. My issue is that I think the spot rate is going to be the same because the spot rate equation and the spot rate function is just going to take into account the coupons and it's not going to care about the accrued interest. But I'm wondering if the fact that we're using the dirty price, if that's going to incorporate everything. Every time I forget that my head is in the way. If we're using the dirty price, I wonder if that's going to incorporate everything that we're doing correctly. So look at the code. Thankfully, it's quite simple. So I'm talking quite a lot. So I need to drink a bit. Or more than I usually talk anyway. Discounted coupon payments. Oh yes, yeah, I've just split it into two. I've done the exact same equation. So if I scroll up, there we go. So this sum here, can you see it? I don't know if you can see it. If I press Control, there you go. So you see where my cursor is. My sum, which is here, starts here, finishes here. That sum is the same as that one right here. So if I can up this thing, and then the rest. So here's the sum in question, and then I incorporate it in there. So if I can show you the spot rate, there it is. Oh, well, there you go. This is the sum in question, and then I add the rest around it to get my spot rate. Let's think about this. If we're using a dirty price, what changes about this? The net present value changes. The previous spot rates. Let's assume we've got correct previous spot rates. We always have to assume that anyway. So we have a dirty spot rate from the past. Our accounting frequency. Now that's when it gets annoying. If our accounting frequency is 6 months, and our dirty spot rate is taken from, let's take the simplest example. Let's say we've got a coupon, sorry, we've got a bond, and we're buying it 3 months before it matures. So we're going to have to pay not only the net present value, but also the accrued interest for that bond that we're buying 3 months before maturity. We buy it. So let's say it's a let's say it's a 10-year bond. You know, it's not a three-month bond. It's a 10-year bond, and I'm buying it now. And there's only 3 months left to it. You could use a 3-month rate. I would always advise, yeah, if you're doing this, then use a 3-month rate. But obviously, what if it's not 3 months? What if it's, I don't know, 19 days, right? Something very peculiar. Let's say you have your spot rate for 19 days right here. F here, what is that? What is F here? Is that your compound frequency, or is that your coupon paying frequency? Because I've equated them up further up. Let's have a look at it non-equated. There. This is the point where it's not equated. This is the original equation. Actually, let me zoom in, because maybe you can't see it. To be honest, it's quite small for me as well. There you go. Here it is. We've got a net present value, we've got a face value. So this is the compounding frequency. You see, we're multiplying, and it's the same here. Actually, the coupon paying frequency is not showing up at all. Yeah, because we don't take it into account. This is to do with the discount factor, not with a coupon. However, here at the top there, yes, of course, we're not taking into account the frequency of coupon payment per year, because the coupon payment given here is always annualized. That is something very, very important to take into account. So, since everything is annualized, I think that it's okay. Why would that be? Why would it be okay? Because coupon is annualized, we're only looking at the compounding frequency, and we're only going for sums. Oh yeah, you see, but we're summing up to that point. This here, this right there, I think this one should be coupon paying frequency. And it gets messy. It gets very messy because, of course, what if the maturity is not a whole number? So I know that the code was fine with it, because we just added the, in terms of price anyway, it's fine. In terms of price, it's fine. If it was fine for the yield to maturity, why wouldn't it be for the spot rate? Why did I think it was fine for the yield to maturity? That's getting a bit meta, isn't it? I'm gonna have to go back. This is it. Let's take the same example. A 10-year bond, and I'm buying it 3 months before maturity. This right here needs to be 1. This here at the top should be coupon paying frequency, and should be 1 minimum, shouldn't it? Because there's always 1 at the end. You can't buy the bond after maturity. So but that's what our code was doing already. I think that's why it was working, because by default it was already doing it. Ah, that's interesting. So in that case, no. There you go. Okay. Yes, it was working because yes, the fact that it had to be one minimum was already encapsulated into our code and our formulas because of this logic function. So you see, if m is larger than or equal to this, it will be this. If it's smaller, it's that. If m is smaller than f, then we're going to use one coupon, and it's this equation, and that works fine. If it is larger than f, then it's either one coupon or more, and then it's this equation up there. But that's good, actually. That works really well. And then we could have like a fraction of a coupon left, but this equation does not take that into account because it's the clean price. We don't care about that fraction. Now we're doing dirty price, and we were fine with it because we were using this clean price equation, and we were very happy with it. This, however, that top thing at the top, I think that should be. What should it be? Should it be the rounding up, or the rounding down, or the ceiling, or the floor? It should definitely be one of them, I think. I don't want to rewrite everything, not to mention that it complicates things that are at the top. And what's at the top is already quite complicated, and it's the start of the article, it's the start of the explanation. So I don't want to throw everything at the start. So I think I'm going to make two sections. One section is going to be clean, so clean prices in the ultimate utilities, and the other one's going to be dirty pricing in the ultimate utilities, and that's when we're going to introduce whatever it's going to be. If it's going to be ceiling, if it's going to be floor, if it's going to be rounding up, or if it's going to be rounding down. Let's think about this. Which one is it going to be? So it's going to be one minimum. And let's say that, okay, so now let's say I'm buying this 10-year bond, and there's 1 year and, or let's say there's 9 months left to maturity. And let's say semi-annual. So I'm going to be paid one coupon for sure. But there you go. I'm going to be paid one coupon for sure at the very end, right? When it matures, but I'm also going to be paid 6 months before. So it's 2. It's actually 2. So if I'm buying it 9 months before, and the FACF is 6, it's larger, so I'm using this top equation right there, so that's fine, it makes sense. And here, I want this to be at least 2, because I'm being paid when it matures and just before. Since I'm being paid when it matures and just before, and I'm given 9, and it's 6, so that would be I want to I want to show all my working out all the time. So that's why I do this. So I've got, so wait, what did we say? 9 months. 9 months and 6. I'm doing this on purpose, but I know you can I think you can just do 9 over 6, but I want to explain what I'm doing. So it's going to be 9 months, but remember everything is annual, so it's going to be over 12. And we're looking at the ratio. I'm looking at this ratio right here, M over F, and F here is the frequency, and we know it's 6 months, semi-annual. So 6 again. In annual terms, it's over 12. Oh, of course, it's not understanding. Divided 1.5. But I want 2 of them. So it's probably going to be the ceiling. So I said 9, yeah, but what if it's just 7? What if it's just above? I still want 2. So I want the ceiling. This is interesting because I'm wondering what my code was doing up to now. Was it taking the ceiling by default? Or was it not? Because if we look at, so let's delete this. If we look at the bottom where I did my tests, there they are. Here. This is the number of coupons. If I do the length of this, it's going to tell me the number of coupons. Let's do let's do the same as what we did before. So we said 9 months, but let's do instead 7 months, right? Which is just before, it's just above 6. I still want 2 coupons. I don't know if this is what I'm looking for. Yeah, maybe this was wrong. The reason being, so here, this list right there is meant to be my list of coupon payments according to these. So let's say I buy a coupon paying bond. Let's say that my annual compounding frequency is 0.5, so this is semi-annual, which is usually the case. Let's say that the coupon payment is 0.125%, so that's 0.00125. Let's say that the yield to maturity, just for sake, is 0.006. You might be wondering why I need to put yield to maturity in there, right? Isn't that what we're trying to calculate? Well, yes, but remember we're using this iteration, this Newton optimization method. So it just takes it as given and then iterates it to find the best one. So here, just for the testing purposes, I'm putting 0.06 because we're not interested anyway. But here you see it's higher than 6. I think that I might have forgotten to add the last coupon paid at the very end. However, I've already tested my yield to maturities and they were fine. So I actually think that this might only be a problem for the spot rates. Let's have a look at our yield to maturity defined function. Should be in there. Yeah, this is our yield to maturity solver. Here it is. No, you see it doesn't take it into account. See, it does face value over all of this minus p plus the sum of all that. But all that, why did I think that it was the correct number of? But my yield to maturities are rather correct though. Could this make a difference? It should make a difference. You see, I did range from 1. Oh yeah, because obviously we're summing where so here, this power here needs to be to the power of 1. If it's to the power of 0, then the whole thing's going to be 1. We don't want that. So it's the power of 1, then it's the power of 2, it's the power of 3. You see, that's annoying because it goes up to the integer, but then I already did plus 1 because I anticipated this problem. But I think the plus 1 only just compensates with the fact that we are starting at 1, not with the fact that the upper limit of range is excluded. That is very, very, very possible. This is annoying. Is this correct? Is this really? Because if this is a problem, then I need to check all of our work. And not only this, but my sanity check at the bottom using icon is all the more troublesome because it should have been wrong, right? If we look here, if we look at the clean ask price, icon ask price, and the ask price computed, icon ask price, they're a little bit off, but by very little. Oh yeah, I already spoke about. I saw that there was one of them was just a bit off. The last bid. Where's the last bid? This one, I guess. Yeah. This one's off as well, right? Because it's 4 decimal points. These decimals do matter though when we're looking at yield to maturities because you're dividing and you're multiplying and you're doing to the power of. It becomes very important. I think this is what I'm going to be looking at. I'm going to stop here, I think. It's nearly 2 hours. I'm going to stop here, and before next week, I'm going to test all of this. Test that we've had the correct amount of coupon payments in that list. See if I scroll back up. I'm going to put this on GitHub, by the way. This is going to be version 25. And you can have a look at all this. what's important. There you go. This is what's important here. It seems like we've forgotten a coupon payment. So before we go further with this, oh no, I can just do +2, can't I? I was going to say there's a little trick I can use to make sure that it works, but let's keep it to what it is because I'm going to do some tests before next week, before our next streaming session next week, and if it is true that we've forgotten this one coupon payment, which is the reason for what I thought was a rounding error, which actually maybe just a calculation error, then all we'll have to do is just change that 1 to a 2. We'll have to do that change everywhere that lists of coupons is generated. All right. Well, I hope this was useful. You've seen the process by which someone tries to code in Python, tries to code these things in Python from the most rudimentary level, which is to say just the prices here. We've only got prices, and we're trying to move on from prices, and it gets really complicated with fixed income. So I'm hoping this was useful. If you have any questions, don't hesitate. Well, okay, you can use them in Twitch in the stream right here, right now. But if you're watching this on YouTube, in the comments below. And also we do have a Q&A page, if I can find it right here. It takes a while. Community.developers.refinitiv.com, and that's where you can ask some questions. You see here, for example, there's some questions already been asked, and people are watching this pretty much 24/7. All right, thank you very much. I'll speak to you next week, and hopefully I'll have an answer, and everything will be maybe even ready by next week. And this, instead of being a stream of coding, will basically be a presentation, a webinar, maybe, of exactly what we're doing this far. Probably not, because I'm going to have to compute the accrual still. We still haven't done. All right. Have a nice day.